Google stock gets more disrespect than Meg Griffin from Family Guy, and rightfully so in the short term of things. As we can see, if you invested $10,000 on Alphabet, aka Google, at the beginning of the year, you would be sitting at roughly $8,800. So right now, the market is completing hating on Alphabet, and I want to say the market is completely wrong. Let's take a closer look in today's episode.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so first, let's just kind of look at just previous movements of overall Alphabet stock. Like I mentioned, if you invested $10,000 on Google at the beginning of this year, you will be sitting at about $8,800. Now, if you invested about a year ago, that same amount, you still would be down. And this is crazy, right? During a time when the AI market is booming, during a time when meme stocks are going up almost 100% in the past in a few months, investors are getting impatient. And I want to say, I think Alphabet is probably one of the most underrated AI stocks right now because they have a lot of potential. And in today's episode, I want to take a closer look at three crazy bullish case of why this stock is extremely cheap right now. I mean, if we're looking, this is a company that just dominates, and this isn't a reason right now. I'm just going to be highlighting some of the cool information for Alphabet. This company's cash and short-term investment about $95 billion. Free cash flow in the last 12 months is roughly $75 billion. Long-term debt of roughly $11 billion. This is a company that has been investing in AI capex, and we can kind of see that downturn increasing throughout September of 2024. But most recently, it seems like the money is starting to come in from these investments, and free cash flow is near all-time highs. Now, we can also see total revenues continue to increase, and net incomes also continue to grow in the last trailing 12 months. So overall, finances are growing pretty amazing, and this is a very healthy company. But yet, PE ratio is trading at roughly 18, looking at forward numbers. And to me, as we're going to see, this is probably one of my favorite bullish cases for Alphabet, is just how undervalued it is. But before we go any further, guys, if you want to learn more, make sure to check out the channel, Jose Najarro Stocks. Thumbs up, subscribe goes a long way. Check out my free daily semiconductor newsletter, whatthechipHappened.com. And also, a lot of the great charts we're going to see today are through our partner with fiscal.ai/Jose. The link is down below, and get 15% off any paid plan automatically and no credit card needed. All right, so I mentioned three main reasons I believe Google is trading at super cheap prices, and why I believe in the long term of things, I am going to be very excited and happy to be a Google shareholder. So first reason number one is just multiple expansion. Right now, Google trades at the lowest PE ratios compared to its peers. I mean, right now, Google trades at forward PE ratios of 18.1, where I'm looking here at the other five here. I mentioned four, but the other five, we're looking at Meta, Apple, Amazon, Nvidia, and Microsoft. All of these are trading in the high 20s. Some of them are actually in the low 30s. So just on multiple expansion and taking it from 18 to a 25, which is still cheaper than everybody else, is a 40% gain. That jumps the price automatically to $235. So if we were to give the same type, not even the same, still cheaper, but just a higher multiple expansion on Google, that right off the bat will give this stock a massive stock boost. And I do believe the market right now is underappreciating this multiple of Alphabet, aka Google, and I believe the opportunity of this expanding, just because the market doesn't understand Google and the strength behind it, is very possible once everybody wakes up. So that is a very easy one. And it's like, not only due to revenue expansion, this is doing levels better or similar to those that are trading at higher valuations or higher multiples. Here we can look at kind of the revenue 1 year growth. And again, all these charts you can find at fiscal.ai/Jose. But Nvidia is the one growing the largest, right? Revenue in 1 year was roughly 86.2. Now, the second one growing at some decent levels is Meta at 19.4. Here we can see that Microsoft and Google are both growing around 14%. Amazon is actually growing at a slower rate, and Apple is actually growing at a slower rate than Google. So, why give this company a lower valuation if it's actually growing at similar levels to your Microsoft and only a few points below Meta platforms, right? The other thing is this is the second biggest free cash flow maker at the moment. We can see the only one kind of beating in free cash flow in the last trailing 12 months is Apple with 98.5. But this is the only one outside of my favorite Nvidia that is actually growing. We can see Apple did grow from 98.3 billion last year, last quarter, to roughly 98.5 this most recent quarter. Looking at the last trailing 12 months, Google is the only one that's actually showing some modest growth, right? It did grow about 2.9% versus the last 12 months a quarter ago. So overall, I think Google is performing on par in forms of revenue growth to those other players and is actually growing free cash flow faster than those other players. So, in my opinion, it should be trading at similar levels in forms of multiple expansion to those other players. And even by giving it a weaker multiple expansion of 25, which is still cheaper than anybody else out there in forms of these forward PE ratios, you will still get a 40% gain right from there. So that's reason number one. Reason number two, in my opinion, it's the AI core and its optionality. When we think of AI, it seems like many are betting that AI is going to eat and destroy Alphabet's moat. It's also the competition in this space, but I think it's completely the opposite. I think AI is going to help a lot of its core revenues. And Alphabet has so much data that this flywheel is going to allow it to have one of the, if not the best models in the long term of things. So, as we see, AI helps improve ads, efficiencies, and effectiveness, which allows them to charge better rates. AI is a tailwind for things like subscription and device revenue. I mean, one of the main reasons I got a Google Pixel was because they were developing so quickly in the AI space, and there was actually a product available from them. And AI helps increase the chance of success of other bets, things like Waymo, things like their drone industry, things like their medical side of kind of drug discovery, and the models that they're working there allow them to have a lot of optionality. So reason number two is AI is not this thesis that it's going to destroy the moat. We'll probably talk a little bit about that later on, but I think it's going to help fuel that moat even better and better. I mean, in personal use cases, Gemini, even though it's not my favorite model, I still do prefer kind of OpenAI's models in forms of large language models. Their Gemini is doing really, really good in forms of benchmarks and from other use cases as well. VO3, which is their video platform, is amazing. Here's a benchmark of VO3 beating VO2, King 2.0, Runway Gen 3, and OpenAI Soros in a lot of preferences. And like I mentioned, Google has data from all avenues, videos from YouTube, both long and short term, text from all the Google Docs, documents again from all the Google Docs slides, search from obviously their queries, and everything that happens on their devices as well. So all this data allows them to make even better and better models. And there's no other company, in my opinion, that has this type of data that will allow them to design the greatest models out there. So again, right now I am an OpenAI current model bull, or I believe they're the kings right now. But with all this data and all the compute that Alphabet, Google will have in the upcoming quarters and upcoming years, I do believe they will be a heavy, heavy competition. So AI is not a weakness for for Alphabet. It is a massive strength. Now, reason number three, and this is probably my favorite reason outside of number one. Reason number one was kind of like the easy answer. Reason number three is probably my favorite, and this has to do with my AI investment. So, cloud growth. Cloud is going to be a massive a massive beast thanks to all the AI demand, right? If we're running some form of AI agents 24/7, if you have robotics, if you have autonomous vehicles, all that is going to be running on the cloud on the one way, not 100%, but all at least some form of workloads within all those industries and all those technologies is going to be used in the cloud. And Google is demolishing the cloud market. While it is not the biggest, it is increasing its total revenue based on cloud revenue. So we can see here the orange is Google Cloud revenues in the last 12 months, and overall the big blue one is total revenue. Now this one is a custom metric that I created here on fiscal.ai, and we can see the total percentage of Google Cloud revenue is increasing. Right now, is 13% of total revenue is coming from Google Cloud. When if we look at March of 2021 or 2021, it was about 7%. And sequentially, it continues and continues to grow. And I believe this is going to continue to be the case. And as Google Cloud growth increases its total revenue dependency, I think the market is going to be more happy to give it a higher valuation. So I think this one trickles really well with multiple expansion. As Google Cloud becomes bigger portion, I think the market will give it a better multiple expansion. So that's reason number 3. And we can kind of see from a recent announcement or the most recent earnings from Google that the CFO recalled that I stated on quarter 4 that we exited the year in cloud specifically with more customer demand than we had capacity. And that was the case this quarter as well. So we want to make sure we ramp up to support customer needs and customer demands. So for quarter 4 and quarter 1 of this most recent year, Google still has more demand than capacity. They do not have enough AI servers. And this is what brings me to the final secret sauce here with reason 3 for cloud growth. And that is Google designs their own AI chips, the TPUs, its own AI chips, and they are really, really good at making them. They're really good at AI workloads. Now, I don't believe this is going to eat away from NVIDIA, but it allows them to grow much faster infrastructure than their overall competitors, right? Let's say they're Amazon, let's say they're Microsoft. Microsoft doesn't really have much of an AI chip, and Amazon, you can say the Trainium Inferentia is okay, but none of them are to the levels of the TPU. If Amazon and Google and Microsoft are waiting for NVIDIA chips, Google could be too. But in the sideline, Google could say, look, while I am waiting for these chips, I can actually order my own chips and build more AI infrastructure, which allows them to build at a faster rate and in theory should help them grow market share. So I think this is, like I mentioned, in the AI space, I don't think no one does it better than me. And I do believe this is a major, major growth opportunity for them. Now, I want to really simple talk about the bear case. And I think there's 2 bear cases for Google. The first is the split up, right? We're hearing a lot of regulatory issues that can probably split up this business. And as a shareholder of Google, that doesn't really scare me too much. Obviously, it could create maybe some headwinds in some of the ways and margins, but an individual YouTube can do amazing. An individual Google Cloud can be amazing. An individual other bets could do amazing. An individual kind of Google search could do amazing all on its own. And then each of those would get a massive, massive valuation boost that I think in theory, maybe in the short term, it could create kind of a negative sentiment. I think in the long term, it provides a lot of opportunities for some great multi-baggers for investors. The second big bear case is the AI eats the search market. And that's theoretically true. I mean, you're kind of seeing kind of less blue links and more just clicking on AI overviews. But I think Google is in a state where they rather cannibalize themselves with AI overviews and stuff like that than get cannibalized by a competitor. Now they hold the kind of way the market is going. They kind of can see where it's moving and can try to monetize those even better. So while it might eat the search, it's not going to eat up the ad spending market. It's not going to eat up the YouTube content creation market. It's not going to eat up the kind of documents and all the sharings and the Gmails and all that. It's not going to eat up the phone business. It's not going to eat up all the other advertisements places that Google is using and collecting data from. So while it eats the search market, I think Google is right now in a direction where they're able to pivot and go into the direction that this new market can take them into. And again, reason number 3, cloud growth, I think, is going to be wild. So, yeah, there you have it. These are the reasons why I believe Google Cloud and Google in general is actually completely undervalued. And while maybe the stock might not react and the market might not understand the stock by the end of this year, I think in the long term, I am going to be very, very happy to be a Google shareholder. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you all next time.